Hello, my name is Kristen Lewis, Director of Marketing for the Consumer Brands Association. We're excited you have joined us for today's Industry Insight session, Growth in an Uncertain Economy, 3 Key Considerations for CPG Companies. This series provides overviews of broad topics that are top of mind for CPG professionals. A couple housekeeping items before we get started. Everyone's line was muted upon entry to reduce the background noise. Now, if you have questions during today's session, please submit those using the Q&A panel at the bottom of the screen. And we encourage you to do so, as our presenters have saved time for questions at the end. Now, let's dive into today's session. Inflation, rising interest rates, spiking commodity prices, supply chain snarls, and an unpredictable labor supply are all converging to squeeze margins and profitability at CPG companies. I'm excited to be joined by 3 experts from PwC who will discuss 3 key areas CPG leaders can focus on for continued growth. Carrie Shea, Managing Director at Strategy & Eric Shin, Partner with PwC, and Vishal Garg, Partner with Strategy & will be sharing their expertise with us today. Eric, Carrie, and Vishal, thank you for joining us today. Over to you.
Thank you, Kristen. Really appreciate, and thank you, Carrie and Eric, for joining with me. Let's get started. Yeah, so what we would cover today is we'll cover 3 broad topics in this session, and hope you can participate along to make it interactive. So as Kristen mentioned, like today, the US economy is at the critical juncture. We'll begin by seeing how this is putting margin pressures on CPG players. Then we'll discuss some key strategies companies can adopt to manage this market uncertainty. And at the end, we'll talk about some of the innovative levers that CPGs can pull to emerge stronger out of this uncertainty. Christine, we move to the next page. So as we think about the overall economy, there are 5 key dynamics that are driving ongoing volatility in the CPG industry. Number 1 is inflation. Consumer price index has risen over 9% over the past few months, and this has been highest since 1982. While the trend is decreasing now, there is no doubt inflation is still going to be on the higher side. This is impacting various areas such as employment cost, consumer purchasing power. Consumer price index was 4.7% early in 2021. In 2022, it has gone up to 8%. Employment cost index has grew from 3.6% in 2021 to 5.1% in 2022. Second is interest rate hikes. Fed has brought in the largest interest rate hike in more than 2 decades to battle the inflation. Fed rate has reached 4.5% by end of 2022, and we expect to see that it will rise further. Expectation is that it will get to 5 to 6% in 2023. Crude oil volatility. Russia's invasion on Ukraine, conflicts within Middle East has led to spike in oil prices. It is expected to remain on a higher side in the near future. What we have seen, and we see that Brent fuel oil increased from $70 per barrel in 2021 to $105 per barrel in 2022. While it is expected to come a bit lower in 2023, it is still expected to remain on a higher side to expected about $90 barrel in 2023. Next is price ceilings. In 2022, companies were good at passing on the increase in the cost back to the consumers, and consumers were, were buying. And that is reflective in the revenue growth in 2022. Most of the CPG companies reported higher revenue growth. However, passing on the same price increase to consumer in 2023 will be detrimental, and it might alienate consumers. So companies need to think about how much price can they pass on to the consumers. And the last is associated with all of this is decrease in consumer sentiment. It has been varying in 2022, although it has been rising recently, as indicated by Consumer Expectation Index. But there are contradictory reports out there which suggest that consumer sentiment is continuing to be mixed between 2022 and 2023. If we move on to the next page, Kristen. So what does that all mean to CPG companies? We in 2023, we see that CPG companies are likely to face both cost of goods sold and SG&A increases, and alongside in declining in revenue growth in 2023. All these factors are converging to impact on different parts of P&L. Our analysis for various CPG companies indicate the magnitude of expected impact on different line items between 2023 versus 2017 to 2021. For example, we expect that revenue growth to decline by as much as 1% CAGR year over year over the next few years. Companies also expected to face a continued increase in cost of goods sold, upwards of 33% due to, again, rise in commodity prices, fuel costs, and direct labor costs. And SG&A will not be spared as well, because the inflation is expected to hit SG&A as well, upwards of 27%. Moreover, while there are news out there of companies reducing their workforce, there is still continuing of a talent war. So for the right talent, there will still be expected rise of the salaries and whatnot. Similarly, continued hike in Fed interest rates is also going to impact the borrowing cost for businesses for new and planned investments. In this kind of environment, companies will have to choose where to invest their dollars while not driving their or stopping their growth. These forces combined will squeeze the overall profitability for companies as upwards of as much as 5% in 2023 and beyond. We move on to the next page, Christine. While the performance of these CPG companies has varied over years, if you were to look at back during 2008 to 2010, like you see the low to mid single digit revenue CAGR, 3%, 3.7%. While during activist era, it slowed down for various reasons. But between 2017 to 2019, they were in this Goldilocks era of continued growth of 4%. Not significant growth in their SG&A and the cost of goods sold, because of which they were able to enjoy good margins. During pandemic period, as I was mentioning earlier, companies were able to pass on to many costs, and like a significant rise in consumer purchasing power due to various reasons led to increase in cost, increase in revenue. Over the last year, that revenue has relatively slowed down, but not as much. However, as we see in future, the revenue growth is going to significantly slow down, further driven by the increase in cost of goods sold, as well as significant increase in SG&A, ultimately driving net decline in margins of upwards of 4%. We move on to the next page. Okay, so all of these are external economic drivers. What can CPGs and other companies can do in this environment? Based upon our experience and our what other companies are pulling, we see there are three big macro strategies companies can employ. Number one is they need to focus on their most valued customers or consumers. Why most valued consumers or customers matter? The reason is that they will be your long-term ally in these turbulent times, but also they would help you focus on the services and the products that matter to them. That will not only help you optimize your portfolio, but also make sure that like you are evolving and emerging strong. Second is you need to empower your people, your employees. For most of the companies, their people are their assets. In order to make sure that like you are driving growth, you need to make sure that you are empowering your people, either by making sure that like, they clearly understand what is the role they have in the organization. make sure that you are developing your operating model that gives them power to drive decisions, and that will unlock growth. And the third is you need to form strategic partnerships. You need to understand what is the role that you play within the broader ecosystem. That means that you need to form strategic partnerships. You need to find suppliers and vendors who will partner with you to help the consumer problems, to solve the consumer problems that are the biggest ones. So truly understand what is your role in the ecosystem, and form the strategic partnerships to drive and unlock the growth. We move on to the next page, Christine. So, and in addition, companies can think about what are the levers that they can pull in the near term to drive the margins. Based upon our experiences, there are several levers that they can pull to improvise the overall margins in the near term. If you were to look across various line items of the P&L, the first one, based upon our experiences, number one is focusing on net revenue management or revenue growth management. In our experiences, we have seen companies can drive as much as 2 to 3% in revenue growth, as well as 5 to 20% in operating income growth, if they are able to apply effectively, build the right capabilities around net revenue management. Second is marketing spend optimization. Over the past several years, companies have significantly increased their spending on their advertising and media spend. However, their ROI has not significantly increased in those investments. So companies need to really closely look at how they are investing and allocating their spend across the media to drive the growth. Within the cost of goods sold, there are a few levers that they can pull. Number one is the procurement, of course, right? Like make sure that as part of your strategic relationships, when you are building with your suppliers and manufacturers, make sure that you are building the long-term relationship that drives optimization of your direct cost. Second is highly focus on the products and the SKUs that are driving growth. You need to simplify. You need to reduce the complexity of your SKUs by focusing on the critical, on the key brands or the SKUs that are driving growth. We have seen companies are able to drive as much as 2 to 5% in the cost of goods sold reduction. Next is design to value. A lot of time companies do not realize which parts of the product really matter to the consumer and which do not matter to the consumer. So companies need to go back and tear down and look at the value that consumers give to each of the elements of the product to make sure that like you are designing to value. Based upon our experience, you are able to drive 2 to 5% in addressable direct material cost. And next is supply chain optimization, making sure that like you have the right network, making sure that you are leveraging your contract manufacturers and other partners to optimize your overall supply chain. One of the big factors within supply chain optimization is going to developing a value chain which is adaptive to the channels in which you are serving. No single value chain can serve all the channels that you have. For example, a lot of companies are now investing in direct-to-consumer channels versus brick-and-mortar channels. Existing supply chains do not serve both the channels effectively. So you need to really develop agile and adaptive your supply chain network. Next is SG&A. What we see is companies. One of the quotes that we heard, from one of the executives was, if everyone does everyone else's job, then there is very less accountability. That means that you need to define an operating model which clearly articulates the roles and responsibilities of the people and the purpose they serve within the organization. By clearly defining the operating model, decision rights, we have seen companies are able to drive upwards of 15 to 40% in addressable labor cost by eliminating any kind of duplicative work that sits across their global organization, across the businesses, and across other parts of the function. Supported by operating model, the other is cost optimization. Really looking at each of the function and understanding how that function fulfills the need to drive and unlock growth. A lot of times what we have seen, particularly in the areas of data and analytics, we have seen every function like finance, supply chain, your HR, your marketing, your sales, all the functions are investing money in data and analytics, which can a lot of times lead to analysis paralysis. So you need to look at each of the function, understand what is the role of that function and how that is fulfilling overall growth. Next is digital value acceleration. With the advent of new tools and new capabilities, companies need to digitize their overall value chain across all the functions. We'll talk about that in a deep dive, how we see companies apply digital value across their value chain. Next is the investment prioritization. As I was mentioning earlier, that the cost of capital has gone up significantly. That means that every dollar that companies are borrowing now is much more expensive compared to the dollar they were borrowing 2 years ago. It means that they need to be much more watchful or worry about where to allocate their next dollar of investment. That doesn't mean that they should stop doing any investment in the growth initiatives, but they need to be mindful how are they allocating and prioritizing the initiatives that will help them in the long-term growth. And the last is tax efficiencies, looking across how the value creation happens across different parts of the world, what kind of capabilities sit in which part of the world that drives significant tax efficiencies. And my partner, Eric, will talk about how those tax efficiencies can help you unlock value.
Yeah, Vishal, just to elaborate on that, for many people on the call here, tax efficient strategy may not be top of mind. Fully recognize that, but for those of you who heard me speak before, I always talk about how all roads lead to tax, which I think is completely true. But at the same time, now scratch that. Now I'm going to say, tax should be at the beginning of the road, not at the end of the road. And why is that? Because as Vishal mentioned, all these different levers that we can pull, and imagine that you've actually successfully increased revenue, cut out costs, you have a huge bump in terms of your margin and profitability, only to find out later that a huge chunk of that is going to be taken out in terms of taxes. So for many of the companies represented here, if you're a US headquartered company, in the US, you could be facing anywhere from 25 to 30% tax rate. So that's a pretty sizable chunk that's going to be taken out after going through after successfully pulling all these value levers. So, for the remainder of the call, we just wanted to highlight, how do you actually fully tax optimize some of these transformation programs? Because we want to make sure that we whenever you're doing these type of programs, that you fully maximize the ROI coming out of this. So we'll cover some of that in detail.
Perfect. Which may move to the next page. So what I will do is I'll talk about few levers that we have seen in the marketplace. Companies are definitely going back and applying. That doesn't mean that other levers are of less value, but these are the levers that we are seeing increasingly come into limelight. Regardless of which lever you apply, based upon our experience, as you go back and reflect back on the margin impact, there is no single lever, there is no silver bullet. So companies need to evaluate in which areas they have already made advancements, in which areas they can further drive the value out. Regardless which lever they pull, based upon our experiences, we see that companies need to find as much as 5 to 10% cost optimization in their cost of goods sold. as much as like 20 to 25% cost optimization is in their SG&A in order to meet the targets that they were achieving during Goldilocks era. So achieving that degree of cost optimization will require companies to look end to end, holistically, and assess all the levers. So one of the levers that we see is net revenue management, and based upon our experiences, it can unlock 2 to 3% in absolute growth while improving overall operating income by 5 to 20%. Based upon what we see, most of the companies currently have NRM or RGM capabilities in their organization in some shape or format. So it's not that it doesn't exist, but what we are seeing more and more is that number one, how advanced it is in terms of digital capabilities. Second is that like how frequently do they apply these capabilities across all parts of the portfolio and all parts of the markets that they have. Often these capabilities, RGM and NRM capabilities, what we see companies apply to select few brands just because of the resources available and time available. Just by increasing the frequency of these capabilities, the companies are able to unlock much more value. So talking about NRM, really, it's a proven technique that can help company effectively manage different aspects like pricing, product assortment, promotional execution, trade investment as a whole. In both these aspects, number one, strategic pricing and investment management. Number one is strategic pricing and optimization. This really begins with the data-driven techniques to understand market structure, consumers' willingness to pay. It helps define the optimum price pack across the portfolio. Different tools such as dynamic pricing and integrated marketing management helps companies extract more value out of it. Next is investment architecture, which is really organization needs to take strategic action to optimize investment across not only portfolio, but also look at their set of customers and apply the tiering and make sure that you have tailored answer for your customers. Next comes promotion and mix management. This really involves execution aspects such as promotion tactics, merchandising guidelines, outlet segmentation, and assortment mix optimization. And then the last is within that is customer and channel management, where we optimize the cost to serve for a particular customer, contract terms, conditions, and manage the overall wholesaler and distributor margins. By holistically looking at this data-driven capability, as I was mentioning, companies are drive significant value on a sustained basis, not only in the growth, but also in terms of the margins. To move on to the next page, this theme is really design to value. And companies are adopting the principles to reduce direct material and packaging costs. Design to value really means optimizing design closely as per consumer requirements and reducing non-value add cost. A lot of times what we are seeing is companies have a tendency to develop a product without significantly taking inputs from the consumer and understanding what consumers value and what consumers do not value. So that means that companies need to take a multidimensional apply levers. First is big-end product segmentation, improvement, flexible designs that optimize the assembly lines, packaging cost optimization, and suppliers clean sheet analysis. So, and then some point, like you will have to make a decision of make versus buy. Are there products that are better off leveraging contract manufacturing as opposed to you leverage your own supply chain to deliver this? Applying the right design to value principles based upon our experience, companies are able to drive 2 to 3% reduction in their raw material procurement, processing and packaging costs, and which can in turn lead to 1 to 1.5% in their net margin improvement. Moreover, this also leads to making sure that like consumers get what they value and everything else is cut out. If you move on to the next page, Christine, I will pass into my colleague, Carrie, to talk more about digital value acceleration.
Great, thanks, Vishal. So digital value acceleration is actually an area where we're getting a significant amount of inquiries about. Recently, more and more C-level executives are calling and wanting to meet on the topic and wanting us to better explain what it is, and how is it different than other digitization efforts. So digital value acceleration, I think it's easiest to explain it by what it's not. So it's not robotics, it's not cloud migration, it's not dependent on data lakes, it's not simple labor arbitrage, it's the creation of digital factories that leverage advanced data science capabilities. And by doing that, they're able to reconstruct and reimagine business processes, business models, and value chains while doing the digitization process. And it's truly an end-to-end solution. So starting with, again, reimagining where appropriate the operating model, understanding the end-to-end customer journeys, then creating and ideating the digital solution design, the build, and then the people and change management enablement. And it leverages a lot of different advanced analytics, a lot of the buzzwords everyone always talks about, AI and ML and NLP, et cetera. But it's also the data science and the advanced analytics and the predictive analytics that are a huge part of bringing value. And that value drops every 12 to 16 weeks. So these are extremely accelerated, agile efforts that are able to generate value in very short increments of time. If you go to the next page, we can talk a little bit more about some of the challenges of traditional digitization programs and why DVA is different. Obviously, there has been a lot of clients that have implemented ERP and CRM and gotten tremendous benefits from it. But sometimes for others, it's a little more challenging to get the value realization. And the reason is because some of the manual processes were not automated or digitized as part of the ERP system or part of the CRM system. So incremental digitization work needs to go on over and above the ERP or CRM type, large scale system implementation. Also, often there's just spot optimization, not fundamental transformation. So DVA provides an opportunity to not just automate or digitize existing processes, but as I said earlier, to reimagine them in a more comprehensive way. And when doing that and looking at the total operating model, you can find some really significant savings opportunities or growth enablement opportunities. And we'll talk in a minute more about some of the benefits, but it's, we had it on the lever page under SG&A, but it really does much more than just SG&A reduction. It helps drive revenue, it helps improve overall productivity. And then, other challenges obviously is just unlocking that investment in data and analytics and making sure you're getting a really great return on. As I mentioned, you could reimagine the business. It is very comprehensive, looking end to end. The factory model is very scalable and agile. And clients have been very happy with as I mentioned before, the very quick, short time to value creation. So revenue growth, enhanced digital channels, better allocation of sales efforts, improved accuracy, reduction of manual errors, which then enable better decision-making, which enables revenue growth. But also improved customer contractual performance, making sure that you are in an automated way, digitized way, being able to take advantage of the contracts you have with your customers to drive additional revenue growth and to just engage with the customer more. We're seeing a lot more application of DVA in the front office. I'll talk about that more on the next page, but there is definitely this opportunity to not just think of DVA as addressing the more manual processes in the back of the house, but also in the front of the house. Cost savings opportunities come from better transparency, allowing multiple functions to be working and seeing the same data and drawing the same insights and conclusions. Being able to better optimize when you have limited resources. And one of the key areas is reducing cost to serve and really understanding the true cost to serve and the complexity that can drive cost to serve. And shortened decision-making, of course, the reduction in cycle times is very important, as well as eliminating waste through the process. And then improve service. So many of the DVA efforts will help to drive better customer satisfaction, reducing their wait time or time to problem resolution, better personalized experiences for those customers, and new service propositions that come up as you build these DVA capabilities. And so from a baseline, kind of what are companies getting from these DVA efforts, we're seeing anywhere up to 3% of revenue growth. So, you know, it's not a step change revenue growth improvement, but certainly moving the needle and staying ahead of other companies that aren't implementing DVA in a more comprehensive way. Productivity improvements up to 30% from a productivity standpoint, and they're improving their net promoter scores, and again, seeing higher customer and higher consumer satisfaction. So if you go to the next page, we'll just talk for a second about, you know, where we see DVA being applied across the CPG value chain. So again, looking very comprehensively from everywhere from product development through the back office with shared services. You know, most people, when they think of DVA, think of IT, HR, finance, you know, contact center, customer care, and CRM, but we're seeing more and more clients applying it, as I mentioned, to the front of the house. So sales analytics, sales ops, sales support, from a store op standpoint, space planning and performance and planogramming, and in merchandising, a lot of the inventory management, replenishment, as well as analytics and reporting, as well as the actual merchant demand planning processes can really benefit from DVA approaches and sprints. And then the forecasting, both demand and supply planning are also areas where we're seeing a lot more DVA efforts going on. And that's not to say that that's like where it ends. You know, I think as clients get more comfortable with the DVA sprints and the value drops, they'll begin to expand into some of the other areas here, which we've shaded in yellow for you. But and again, it's not to say that there won't be opportunities even within some of the areas that are shaded red here. But typically, clients and companies start in the green and then sort of migrate to the yellow, and then eventually begin to tackle the more challenging areas. So with that, I want to turn this over to Eric, because I think his tax strategy discussion really builds off of this and shows additional incremental ways to gain benefit.
And thanks, Carrie. If you just stick to the prior page, if you don't mind. By the way, Carrie, there was a question that came through on the chats here. What is DVA? So DVA stands for Digital Value Acceleration, which essentially is use of whether digital factories or digital solutions to actually come up with an approach and really create that value in a short sprint manner. So I think this is an approach where you don't need to wait 6-12 months to realize that value. It is a quick sprint where we are actually, you know, realize that value drop within the 8 to 12 week period. So that's what DVA stands for. And if you look at this capability mapping, this is actually what we use from a tax perspective as well to determine. I think Carrie talked a lot about new ways of working, new processes, new operating model that Vishal mentioned before to kind of really realize the full value. And one critical component to that is location. So from a tax perspective, whenever we go down route of these type of transformation programs, the first question that we ask is, you know, all these different value levers we're pulling here is to generate value. So where do you want to generate that value? You want to create that here in the US? Or should we think about new ways of working and new, you know, building new teams and new processes elsewhere so that value creation and that future income recognition happens in a lower cost or lower tax environment? So, you know, it's essentially, you know, if you look at, again, going back to what Carrie was talking about in terms of this whole concept of digital factory, to me, that there's been clearly an evolution of this model where, you know, we've seen a lot of offshore shared service centers, or it kind of evolved into global business services or GBS, kind of focusing on back office functions and shifting to a lower cost environment and to fully realize the benefit of the labor cost arbitrage. Well, it's essentially, why not also go through the same type of analysis to identify some of the key roles that can be shifted out of the US in a tax efficient location to not only realize a labor cost arbitrage in terms of some of these functions that are being centralized in those lower cost jurisdictions, but also more strategic roles that can be put into a lower tax environment, so we can actually take advantage of the lower tax arbitrage as well. So it's essentially, it's a means for us to realize labor cost arbitrage, and through digitization, almost a labor cost reduction. And then on top of that, get into an operating model, we can also realize some tax savings on top. So we can go to the next page here. So again, I think as I mentioned before, it all really starts with the first question at the beginning of some of these programs, kind of deciding where do you want to create this value? Again, if it's all, without proper thinking, if just all the value is realized in the US, clearly that's great. You're able to realize that value. But US, even after major tax reform that happened back in 2017, still probably not as competitive as the rest of the world. So again, for a typical US company, between US federal and US state taxes, you're probably talking about anywhere from 25 to 30% of tax that's going to be taken out of whatever the value accretion that you're anticipating. So how could we actually change the dynamic, change the paradigm a little bit, where, hey, should we think about doing business slightly differently without interrupting business, where we can actually start to accumulate this value elsewhere in a lower cost environment. But then, at the end of the day, there's a common term, tail can't wag the dog, so tax cannot wag the business. So again, you have to do what's right for the business. So even if the decision, regardless of the location decision, we also can look at, are there any local credits and incentive type of opportunities? I think we all know that some of these, to realize some of this value, some of these programs, there's quite a bit of investments that are being made, investment both, people, process, and technology. So we can also take a look at, are there some unique credits that are available locally? Again, regardless of whether the investments being made out of the US or elsewhere in the world, there's unique opportunities to claim those credits. For example, in the US, on certain technology investments, we've seen instances where we can claim up to, you get about 10 cents back on the dollar of spend. So that can significantly improve your ROI and actually serve as a pay for. And also, if you're going through any type of situations where you're creating new jobs, there are local governments where, to promote job growth, they would actually give you money back to actually promote some of the new job creation. So there are a bunch of different, again, whether it's a kind of income accumulation into a better tax environment or credits and incentives. I think the key message that we want to convey here is, a lot of times, and when we have these discussions, and a lot of times it's actually outside of the tax function, it's with the actual program sponsors and program leaders. The key message is, if you do it in a thoughtful way, the tax savings that can be generated from some of these new ways of working and some of the credits, it can significantly help improve the ROI and help offset the cost of running some of these transformation programs. And in some cases, it could fully offset the cost. So I think that's a pretty powerful message here. So again, I think I think I used to say all roads leads to tax. If I could have everyone think in terms of tax free at the beginning of the road, I think I've done my job. So I'll turn back over to you, Vishal.
Thanks, Eric. I think really, so Eric, I don't know if you want to add anything on this page, but I think
I think this is this page is simply, if you're actually able to get tax at the table. By the way, those of you who may have already guessed it, I'm part of our tax consulting practice, so working closely with our transformation efforts. And if you were actually able to do these things in a thoughtful way, obviously the ending result that we were targeting is lowering your effective and cash tax rate, and more importantly, minimizing risk and providing that full financial transparency. And again, what's most important is, once you get into the model, we want to be able to sustain that. And so what is that sustainable tax model that you get into, so you can actually defend that in case of local audits going forward? So these are kind of the intended outcomes. But again, I think most importantly, just making sure that we are giving proper thoughts to how do we actually, one, manage risk, and also try to find opportunities to tax optimize some of these programs, then again, the net result is how do you maximize your ROI coming out of these programs?
Thanks, Eric. So with that, we will open the floor for any Q&A, and we are happy to answer any questions. So while we are waiting other questions, one of the questions that I now see is what leading practices do you see in terms of cost reduction efforts across the extended value chain and ecosystem? I'll start answering, and then Carrie and Eric, feel free to add your experiences. Really, leading practices, a lot of time, when companies think about these cost initiatives, they generally take these cost initiatives as a energy shot, if you will, that is supposed to drive one time bottom line impact. What we truly see, the successful cost programs always start with clearly defining that what are the 3 to 5 differentiating capabilities that companies need in order to win in the marketplace, that drives the right to win. Once they have defined what are those really truly 3 to 5 differentiating capabilities that no one else can replicate, then the second step is to really understand what operating model do I need to support those 3 to 5 differentiating capabilities. And everything else needs to then closely looked at and put back onto the table and almost clean sheeted, right? A lot of times, again, companies try to, when they try to take these cost initiatives, they just, okay, let's take 15% out of my function. That generally do not take out the cost, and it always create burden on the employees that are left behind. So you need to really think about, when we are changing our operating model, what kind of work we need to stop doing. And then what kind of work we need to really emphasize that, again, that supports your differentiating capabilities. Once you have defined that as part of operating model, and I was mentioning earlier, focus on defining the operating model that promotes a role-based organization or role of an individual as opposed to team-based organization, because oftentimes when we see is where the teams create the silos within the organization. And the third thing then companies can do is look across every function, look across what kind of cost structure do I need within each of the function to achieve or drive that operating model behaviors that I want to enable. Within those cost structure would be your decision rights and the role of global functions versus business versus all other center of excellences that companies need in order to win in the marketplace. Carrie, Eric, anything else that you would like to add in terms of best practices that you see?
No, I think you did a great job explaining that, Vishal. And I think the one thing that we do see a lot more companies doing is looking outside their own 4 walls to really attack the cost drivers that are coming and the growth opportunities that are coming either upstream or downstream. So, whether it's their contract manufacturers or whether it's their customers or distributors, they are looking to create cost reduction programs or growth enablement programs that really pull the value chain together, the extended value chain together, and jointly work on those opportunities together.
And Carrie, one area that what you just talked about, it comes to life, dealing with some of my clients, especially true in the procurement area, where typically really taking complete ownership of the value chain and breaking it down and trying to squeeze as much savings each step of the way. For example, completely taking on, freight cost or, kind of the shipping cost, something like that, ocean freight, whether it's ocean freight or ground shipping. Typically, it could have been an outsourced model. Now companies are looking at, are they better off actually taking complete control of each of those components? And procurement is just one area, but I see that kind of happening at every step of the way. And also, Vishal, going back to your point about, almost like sometimes a shock to the system is necessary and reevaluating the operating model. So I also see a lot of, hey, in-source versus outsource, where can we get the most bang for the buck? I think those conversations are also happening.
The other question that I see is are more companies trying to simplify their product and brand portfolios in order to simplify their cost structure? So that's a good question. In fact, I was at CAGNY this year, and in CAGNY, one of the things that was very, very clear was companies are hyper focusing on their portfolio, the portfolio choices that will drive the long-term growth, and everything else gets divested. And one of the big drivers of that is by focusing on the portfolio that will drive the growth, they can correspondingly look at what is the cost structure that is needed that maximize the value of the organization, as opposed to focusing on everything and not divesting the products that are not core for their growth.
Yeah, Vishal, I would just add that, we've seen more companies, to your point, stepping back and saying, how attractive are these categories going to be in the next 3 to 5 years? And then how well positioned is the brand to compete in that category, given this, threat of recession, ongoing inflationary period, and taking a hard look at those brands that kind of fall in the bottom quartile of the category is really not that attractive, and the brand is not that strong. Those are the easy divestiture opportunities, but then there's also those where the category is not that attractive, the brand's still doing well, but do we really want to stay in that category and making those hard decisions? I think we'll continue to see more of that in the coming years.
One of the things that we've been dealing with our clients in terms of, looking at the portfolio, even before you're able to go through that analysis, do you have the right data points to be able to make that determination? So, for example, you may have financial data, but one thing that we've been working with multiple clients on are, you have this huge pool of fixed costs and how that gets allocated between different portfolios and different brands. And then depending on how that gets done, the true profitability of the brands may not be all that transparent. So we've been having multiple, different initiatives and different iterations with clients in terms of helping them determine, even before that decision is made, like providing that transparent data so the right decision can be made.
Let's see, what else is there? The other question that I see is that what cross-functional cost reduction initiatives are working best? I think this is an interesting question and pretty wide actually. While there is no single answer for which cross-function initiatives are working best, but what I do see is a lot more companies are focusing on identifying these end-to-end solutions that are needed for successfully running the business. Traditionally, or even right now, what we see is companies are very functional focused, as opposed to thinking about the end-to-end solutions that are needed to solve a particular problem or solve a particular problem for customers or consumers or even internal employees, if you will. So the more and more companies can pivot to this notion of end-to-end process, if you will, right? Like either if you were to think about idea to market, your procure to pay, hire to retire, these kind of initiatives not only make sure that we are eliminating any kind of functional silos, but also make sure that we are focusing on these solutions that are needed to solve a particular problem. So again, as I'm mentioning, that there is no single initiative, but the more and more companies can focus on thinking about problems in more end-to-end, the better they are in terms of solving the problem.
Yeah, and I would just add to that, I think that one of the areas we've been seeing a lot of focus on is the commercial decisions that are being made and how it impacts supply chain costs, and just really digging in, understanding more transparency to that, so that when the sales folks and marketing folks are involved in commercial decisions, they're able in a much more real time understand if they make this choice or that choice, how's it going to ripple through the supply chain. And that's something that, that added transparency is so important for making good decisions.
And because of that, Carrie, I think as a practice, we're working on more integrated business planning projects than ever, right? I think COVID completely pressure tested, the supply chain organizations and ability to really be able to source, make, deliver in a timely manner. But then that connection back to the commercial team, that's so critical.
I see one more question is, what have you seen in terms of creative funding for cost reduction initiatives? Again, this is pretty interesting. In fact, like over the past many initiatives that I've worked with the clients, I'm seeing that clients want to see, or CPG companies want to see, how do we self-fund a lot of these initiatives? I mean, if you were to think about your marketing spend, we see that instead of how do we make sure that whatever the work that we are doing, it pays for itself, and we are able to do a lot of stuff, like for example in marketing and in their A&M spend, we are able to reallocate in such a fashion that companies don't have to find more money, but in fact the savings that are identified through those initiatives, not only self-fund that initiative, but also the savings they identify can be reinvested in the areas that trigger growth. So it applies to your marketing spend. It applies to your operating model. A lot of these initiatives can very well self-funded, so that companies don't have to again like find more money or borrow more money.
And I go back to the point that I made before, even taxes or tax reduction by doing it in a tax optimized way, that could be a funding mechanism also.
And then I see one more question is, what sectors within CPG do you expect to be more impacted with current market conditions, and why? So this is again, right, like one of those questions. When you think about consumers, really, any CPG company which is dealing with the discretionary spend will get impacted. Any CPG company coming out of COVID, if you will, right, that took a good rise because of COVID impact will get impacted, and we are already seeing that impact in many companies who built or invested huge money in their supply chain, but now they have to reverse back just because consumers don't want to invest or buy so much money on the COVID era products that took the rise. Eric and Carrie, any of your experiences in this area?
Well, the one I would add, which I think we kind of overlook sometimes, is the food service side, and that's really tough right now because of restaurants are having so many margin issues. They have a labor constraint issues. They've got increased costs of technology. The Food Modernization Act that's coming through with lots of new requirements regarding food traceability. It's making it very hard for the restaurants, and then for the distributors that support those restaurants, and then for the CPG companies that are selling their products through. So just, tremendous margin pressure in that side of the business right now.
And I'll say not necessarily from a specific subsector, but I think it kind of goes back to companies who actually got their input costs right and adjusted through the ultimate pricing that got passed on to the customers. I think we've seen all variations of who's been able to do that better as opposed to others. I think as the input cost comes down, like ability to actually realize that margin, I think that's going to vary by companies did they have that right initially, or did we have the input cost wrong? So like we didn't have the price increase right. I think the margin difference is going to really uncover itself as the input price comes down.
No, you're absolutely right. Just to augment on that, really, like as we see, and going back to the beginning of my presentation, that we see that most of the CPG companies will get impacted one way or the other. Companies will not be able to pass the rise in cost back to the consumer, so there will be impact on revenue. The commodity prices for the raw material is not going to come down, so there will be margin pressures. There will continue to be labor challenges, right? Like with many kind of layoffs, even in Silicon Valley, the unemployment rate continues to be lowest in a decade. So there will continue to be the cost pressures as well as the revenue pressures across most of the CPG companies. I think those are the main questions. Christine and James will pass it back to you.
Great. Well, Carrie, Eric, Vishal, thank you again for joining us. And thank you to PwC for their continued partnership with the Consumer Brands Association. Consumer Brands has several other industry insight sessions scheduled in the coming weeks. So please visit our events and education page. There's a link in the chat to view these sessions and register. So thank you all again for joining us, and we hope to see you again soon.